We have a special guest today, Steve Singer, out in Silicon Valley. And Steve Singer works with a lot of family offices, helping them preserve their wealth. And just got back from Davos, right?
Yes, I did. It was very, very interesting.
All right, so tell us what happened over there in Davos.
Well, it was pretty cold. The temperature was down to -4, but still got around. It was really interesting because this year, as opposed to prior years, a lot of the world leaders weren't there. So it wasn't as crowded as it was in prior years in Davos. Additionally, last year, what I was looking at is that there were a lot of cryptocurrency companies on the promenade. And this year, out of last year, there were probably 30. This year, there was only 2. And that's probably because of the drop in the price of Bitcoin and also what's going on with the cryptocurrencies.
So you work with a lot of family offices throughout the country. You help them preserve their wealth through tax knowledge and also through investing knowledge as well. So can you share a little bit about what you're working with the families currently?
Yes, I wanted to share a couple different things. One is on alternative investments. I see a lot more venture capital and also these family offices that are investing in a lot of startup enterprises right now. Additionally, I see a lot of the family offices, especially on the West Coast, they're investing in like diamonds and art pieces and cars. And so that's really exciting because those particular assets, even though the economy is going really well, they're doing better than what the economy is doing. So it's very interesting to see what's kind of going on with that.
Karen, you like diamonds?
I love diamonds. I was thinking we're talking about saving money. We've talked about diamonds and luxury. I mean, what could be better? This is a great show so far.
So Steve, tell us a little bit about the luxury investments and how that's working for the families.
Well, some of our families are investing in Ferraris and Bugattis and other exotic cars. And what we're doing in terms of a tax position is we're positioning them so they don't have to pay or minimize the sales tax liabilities when they're buying them. Also, what we're seeing is those are really appreciating assets if you have a family office that understands how to invest in those types of assets.
Okay, and go ahead, Karen.
I was going to say a car is an appreciating asset. Like that's not something I would think about. I would think about it being a depreciating asset.
Well, if you've got Ferraris sitting in your backyard, then they actually have a pretty good value track record on investing in them. So we're seeing a lot of those particular assets being acquired. And also, especially on terms of the very, very fancy diamonds and rubies, where those are appreciating probably one that I'm looking at right now is appreciating like 30% per year over year. So,
Steve, the families in California, a lot of tax over there, a lot of state tax, and we continue to see people moving out of California because of that tax purpose, right? The high state tax. So what do you see? What are you doing with the families over there?
I'm advising them to get out of California. I'm advising them if they have enough net worth and they're buying houses all around the United States or around the world, that they shouldn't really get out of California because the tax rate is just way too high. And the new governor is also looking at increasing the tax rate for us. And so I'm not really happy about that either.
Why such high taxes there?
Because it's California, a lot of Democrats.
Yeah.
So, go ahead.
So are the businesses moving out, or, obviously there's a lot of tech, a lot of startup there. Is that changing?
Yeah, we're seeing a lot of movement coming out of there. A lot of stuff going in Austin. Actually, even when I was in Switzerland, I went to Zurich and visited ETH, which is the MIT of Switzerland over there. And you're seeing Google coming in there and Facebook coming in there. They're really creating a lot of different entrepreneurs over there because they're gobbling up all those college students. So you're seeing the technology workforce kind of really going global right now.
Okay, and how about, when we invest out here on the East Coast, we're looking at alternatives, but we tend to have a different type of alternative investment strategy. Over in California, we see a lot of cannabis investments and things of that nature. What do you see in terms of the differences?
I see that where the wealth creation is in California is in real estate and also in technology. So most of the families over in the West Coast are very, very familiar with technology. So they're used to looking at those particular deals in technology. When I go over to the East Coast, I see the family offices kind of grouped together in terms of investing. And those family offices are trying to have the grip of determining whether or not the investments are really good or not. And so that's a challenge for the East Coast offices to look at. Whereas opposed to the West Coast offices where a lot of the wealth creation is from entrepreneurs or from venture capital, they're used to looking at hundreds and hundreds and hundreds of deals. So what they're looking at is a different kind of aspect of it than is on the East Coast. And then also because the West Coast have a lot more investment here that I see in blockchains and cryptocurrencies and AI than I see that's happening on the West Coast. I mean, sorry, on the East Coast. So it's a lot different what's kind of going on over there.
Aaron, what do you see over here?
Listen, I'm still on cannabis. We went from luxury cars, we went into, art, we've talked diamonds, and now we're on cannabis. Cannabis is such an interesting investment. I think for people on the East Coast, it's something that's a lot more understood, obviously, and on the West Coast and in California. Do you see a lot of people on the East Coast now going into investing in cannabis?
I see they're kind of dipping their toe into cannabis. A lot of the Canadian companies are coming in and scooping up a lot of the cannabis production. And so you see a lot of movement on that side. Because in the States, it really isn't, how can I say this? On a federal level, there's an issue in terms of the taxation issue and dealing with cash and dealing with banks. So I think that you see that the Canadian companies have a better handle on it coming in. So they're a little more hesitant to come into the cannabis arena. I do see it if they are trying to synthesize it. Like when I was in Davos, they were talking about synthesizing cannabis or making sure that when they're growing, it's very, very high quality. So it's more still on a medical marijuana side. Mm-hmm. But I see on the West Coast, where you have a lot of pot growing going on here in the different regions. I was talking to one of my friends, and there's like 3 or 4 different, these millennials who are creating different food products made with cannabis. Wow. So it's an up and coming, thing going on here.
Yeah, it's a hot topic. So, it's interesting to see what's really happening behind the scenes.
Is that a pun, a hot topic?
It was. It's on fire. The topic's on fire.
Hey, Steve, what about, you're getting ready to do the taxes for all your clients and tax season is upon us. Can you give the audience maybe 5 tips on what they should be thinking about to lower their tax liabilities as we head into tax season?
Well,
I know you gave us one, which is move out of California.
I think the other issue is maybe looking at, not for 2018, but 2019, there's a growing interest in these opportunity zones, which people should be looking at, because that is the ability for anybody who's got any capital gains to go reinvest those gains into an opportunity zone to defer paying any of the tax for up to 10 years. And then only paying 85% of that tax after the 10-year period. And then also, if you do have certain developers who are really good at developing real estate and they're in gentrified areas, then there's also the ability to go in there and actually not pay any tax on any of the gain if you held it for 10 years. So we're seeing that aspect of it. The other aspect is that the IRS right now is issuing huge amounts of regulations. Like last week, they just came out with some other proposed regulations and just clarifying more on who is eligible for this 20% qualified business income deduction. So I've been sitting there late at night reading all these particular regulations, how it applies to real estate, there's some issues in regards to real estate on how you can qualify that, what doesn't qualify. So those just came out. So we're advising our clients on how to restructure certain of those particular aspects to get the 20% deduction on some of those things. And the third is just as in general is how to estate plan for the stuff. Because of the higher estate exemption rates, is that they should really take advantage of this while it's still in play here, either using GRATs or CRUDs or different type of a leveraged vehicle, so to minimize the estate tax impact for their kids and their families.
So what else do they have to get ready to prepare to when they're going to their account, their CPA, to best maximize the write-offs?
I think for them, it's a question of, it's always a thing of lifestyle issues. So the question is that how much do they want to simplify their life or how much do they want to complex their life? So to me, whenever I have these discussions with our clients, it always kind of revolves around lifestyle issues. And so from the lifestyle issue standpoint, that's where we kind of come in there and coordinate all of the different trusted advisors for the client to maximize that. So it's not really impacting the client itself. So they're to me more stress-free. And that's really, to me, our objective is to make their life easy and stress-free so they can live it the way they want to live it. Let us deal with all that other stuff, okay? Because who wants to really think about taxes seriously?
So what are the biggest changes to the tax code that you're seeing for the families, and how is that impacting them, and how do they best mitigate these changes?
I see the changes in the itemized deductions that are happening a lot. So, the question is how to restructure some of these itemized deductions so that they can take advantage of them as business expenses, especially when they're running their family offices, how to restructure some of those things. The other big thing is that the loss, I'm going to say this, when you create losses because you sell your assets and you have these losses that have been accumulated over years, and all of a sudden they get released. You may not be able to minimize those particular losses, and so the question is, there's a lot of planning that comes around there in terms of the timing on that. And I'm also seeing a lot more of planning on some of these family offices where they haven't been thinking about this on whether or not they qualify for any research and development credits, or in fact, if they have any real estate for doing any cost segregation surveys. So if we can do any cost segregation to really increase the amount of expenses they can do, especially when you have these very favorable depreciation rates that we can take advantage of, and they have other income they can offset and combine the whole thing together, that they can really offset a lot of the tax liability at that particular time. We're also looking at the differences between the lowering of the corporate tax rates and seeing whether or not we want to either incorporate into a 21% flat tax for a lot of these different corporations. So there are a lot of different advantages of either starting out as a C corporation in having the ability to not pay taxes up to $10 million of whatever the gain is down the road if you hold it for 5 years. So we're looking at those particular issues too. So for us, we're kind of busy, and that's not even talking about whatever the foreign element is with foreign taxes, which has become a very, very hot and complex arena just because of the way the tax laws have really, really changed. So we're seeing a lot of movement in a lot of different areas.
Steve, with the companies there, and they're getting a lot lower tax rate on the corporate side or through the pass-through on the flow-through companies, what are the companies doing with that tax benefit? What do you see happening there?
For me, on the private side, I see that they're they're reinvesting a lot of the different cash. For the families, sometimes I see, depending upon what their objectives are, if their objective is to grow, then they're going and putting it back to the company. If they're looking at doing exit strategies for the next 4 or 5 years, then what they're trying to do is they're trying to increase the sales and the profitability so they can sell it. That's what I'm kind of seeing in terms of those particular companies and their families, if they have closely held businesses.
Karen, we've seen so much benefit in the lower tax rates for the corporations.
Yeah, and this flat tax is really interesting too with this 21%. I'm hoping Steve maybe can elaborate a little bit on that.
The 21% tax rate I see is very good because it makes it a lot more competitive from a worldwide basis. And so as a result, when we're looking at these 21% tax rates, most of the companies that I'm working at are profitable companies if they're family run. If I'm looking at the startup companies, then the 21% tax rate's not going to kick in because you've got a lot of venture capital funding on those things. So it's not as important right now. It's more important that we preserve a lot of the NOLs, especially when you have changes in ownership. So for example, I had a company, they had a windfall of about $80 million of income from a different source. And so as a result, we were able to go back and utilize these NOLs and save them probably about $25 million in federal taxes just from that particular standpoint alone. Additionally, on these startup companies, I think what the real big beneficial thing is for the R&D credits for the payroll tax. One of my companies that I think was they're up on their second or third round, they raised about $60 million, and they were able to save about $225,000 just in that R&D payroll tax alone. So these are really, really cash flow issues for the client. They're able to go in, reinvest those proceeds in developing more product. Most of the companies out here that I'm seeing are in the AI arena and the blockchain and cryptocurrency. I see also on the nascent level that are kind of coming out, which is more on the augmented reality and virtual reality. You see a lot of that stuff kind of coming into play right now. You'll see it a lot more coming in when the 5G networks start coming in because you have a lot more data that's being able to go back and forth on some of that stuff.
I think the corporate tax rate going down to 21%, like Steve said, makes us so much more competitive as a country, and it's so great to see that tax reform is having a huge impact on jobs and job creation and companies bringing profits back into the country. And thank goodness. And I wonder, Karen, what do you think? That'll be addressed tonight in the State of the Union?
Yeah, I mean, I think these are the upside of having a good economy. And I'm looking forward to the State of the Union tonight. I think it's going to be really interesting what he's going to talk about. I think a lot of it's going to be border funding, but I also think we're going to hear a little bit about this booming economy, and that I really look forward to. Saving money, who doesn't like that?
And jobs. I mean,
yeah.
Look at it, the job report that came out, I think this week, was very, very positive, where everybody was trying to say because of the government shutdown that would be a negative impact, but actually it's very positive. It was kind of coming out, which was refreshing.
Internet companies, what's the issue with the tax there now?
I would say it's still up in the air to a certain degree. And the internet companies that I'm kind of looking at are more from a sales tax issue. There was a decision that was, I think, back in 2018 called the Wayfair decision. And so a lot of the companies that are selling on the internet, they're going to be subjected to a lot more state tax, not the federal tax, but the state tax in terms of the Wayfair decision on sales tax. In terms of taxing other things on the internet, that's an area where I don't have a lot of expertise in, so I can't really talk about what the FTC is going to do in terms of taxing, those kind of carriers and things on the internet. But the big thing is on sales tax. So that's one of the other things that we're looking at with people with diamonds and with very, very high-end merchandise, of how to not pay sales tax and still being able to enjoy the fruits of whatever they're buying.
Steve, how does someone know if they have a good CPA or not?
Well, that's a good question. I look at it and I kind of say a good CPA not only will save you taxes, but it's also what other relationships they bring to the table. So if all your CPA is doing is paying taxes for you and minimizing your tax effect, I don't really think that you have the best CPA. I think the best CPA for the family offices are ones that are able to provide you with other resources. For example, I'm seeing a lot of family offices that want a lot more deal flow. So what I've done and what our company has done is gone out to a lot of these different universities that have entrepreneurs coming out, and we're able to present those particular companies to our family offices. As long as they're able to analyze whatever that deal is, it's a good thing for their family office. The other thing is being able to educate, their children and also their grandchildren about what it means to be socially responsible, what social impact is, what it means to be financially secure, how to use wealth to the benefit of humanity, not just for the benefit of yourself. Looking at bullying issues and how to avoid those, especially when you're dealing with, people who aren't like-minded of you, how to respect other people so that there's stability in terms of whatever's going on in the family, and how to really kind of respect people in your family. So those are the kind of issues that you should be looking at your CPA, and also somebody who is going to keep you out of trouble, keep you out of jail, right? And also being able to introduce you to people who also are able to create more wealth for you. And so that's kind of what I look at when I look at somebody who I think is a good CPA.
So if we're interviewing a CPA, what are the questions our audience should be asking the CPA before they hire that accountant?
I think that the issue is that the CPA should be starting to ask you questions and you to listen to what you want. Okay, so once they understand what you want, then the question is that let's talk about how to achieve your objectives. And again, what I was looking at is what is the lifestyle that the person wants to have, and how to impact that lifestyle to make it better for them and their family. And so those are things that you should be listening to from the CPA, not just talking about, well, my firm did this, my firm did this, my firm did this. That's something that they're talking about what they did. They're not listening to you. And so the question is that what is it that, what can they do for you? What is it that you want? And so that's what you should be looking for.
And do the CPAs help with the investments?
Some CPAs,
from a tax standpoint?
Yes, from a tax standpoint, we can help with the. For our firm, we don't sell product. So in effect is that we use other wealth advisors to help with those particular issues in terms of those. But again, to me is that because we're the trusted advisor, we see a lot more than just one investment advisor. So we're trying to quarterback and giving most of the other investment advisors or other people on the team enough information to make sure that the client's objectives are being fulfilled.
Hey, Steve, before we let you go, should we build a wall around California?
Well, if
there's already one around the governor's mansion.
Yeah. Well, I don't know. If you build a wall around California, what are we going to do with the surfers? Okay, because they're just going to hurt the wall and they're going to hit the wall. So I don't know
where the robot's going to go.
And where are the wall robots?
Where the robot's going to go?
I mean, we can always use the drones because we have a lot of drones flying around in California right now. So you never know about those things. So, I don't know what else to tell you.
All right, Steve, great having you on. We'll check back with you in a couple of months and find out what else is changing on the tax side.
Well, thank you, Julio. Thank you, Karen. I really, really appreciate the opportunity.